All right, folks, this is a question I get a lot when I'm sitting down with people when they move their money, a large lump sum, into a fixed index annuity, a FIA. How does it really work when it comes to taxation? Because a lot of people don't talk about the taxation in a fixed index annuity or just annuities in general. How does it work when you're moving the money over? Because yes, the growth is 100% tax free. You have tax advantage accumulation, so all the money that's growing gets to accumulate tax free. So you got $100,000. That $100,000 grows to 500,000. Well, that $400,000 of growth is tax advantage, tax free money you can loan yourself, create yourself a lifetime income. But the initial money that comes in, that principal, in that example, 100,000, it depends where it comes from if you have to pay taxation on it. But they call it qualified. Either it's qualified or non-qualified to be taxed. And it exactly what it sounds like. You either qualify to pay taxes or it doesn't qualify to pay taxes. Now, it always is how the money comes in. So if you have, say, a 401k, a traditional IRA, some kind of account that has not already been taxed, folks, hasn't already been taxed, then that is qualified to be taxed once you move that money into that account. So that $100,000 in the example I said, the $100,000, that comes from a 401k, for example. There's taxation on it. You have to pay the taxes on that 100,000. Boom. We understand that. Now that 100,000 grows to 500,000, that 400,000, that's a tax-free growth. So you hear a lot of people talking about, oh, you can grow your money tax-free. It grows tax-free, but it depends where it's coming in from. And then you have options. Once you do it, you can either option A, I got 100,000, take out the taxes right now. So I come in with 76,000 up front. I paid the taxes, I'm good to go. That 76,000 gets to grow. Or you could have the whole 100,000 pretty much go into your annuity, and then you could get taxation once you start withdrawing, that withdrawal process down the road. So make sure you understand, because a lot of people say, yeah, you could roll your 401k that's going to grow tax-free. It's true. Your IRA, it's true. But a lot of folks fail to talk about if it's qualified or not qualified to be taxed once you initially roll those funds over. Reason why I'm bringing this up to you guys, because I had a client earlier today. They were told they got 100,000 in the 401k. They can move that for like 130, but let's say 100k. They have that money in a 401k. They can move that whole 130,000 over, and that 130,000 is going to grow tax free. They don't have to worry about taxes. Period. So whoever was the person who talked to them, most likely it's a life insurance agent, because that's what we call a 214. Well, Florida is called a 214. Some places call it different codes, but it's a life, health, and annuities license, or just a life and annuities license. So they're told them they could roll everything over. You're not going to have to worry about the taxation on the 401k part. Absolutely ridiculous. So if you're thinking about a fixed index annuity, I'm not here to say if it's good. I'm not here to say if it's bad. I got a couple other videos. You could go on my YouTube to see the pros and the cons of it. But the initial principle, if it's going to be qualified or non-qualified, you need to know how that works. Some companies, like I said, option A, you could take the taxes up front. Option B, down the road. Some companies, some annuity companies, they have bonuses. So that bonus could be used to offset. I have 3 companies on my platform that give over 20%. I have a 20%, I have a 22%, I have a 26%. So day one, you can get a 26% bonus. If it's just coming from your bank account, that 100 grand, that's perfect. But let's say if you have 23%, 24% in taxes on your 401k, that bonus could kind of be like an offset. So that's why you see a lot of these bonuses for your annuities. So folks, hope that breaks it down, because there's too many people, especially they have that fear mongering going on. Oh, the market's about to crash. You could lose all this money in your 401ks, this, that, and the third, all your retirements, investments. We're not worried about that. That's a whole nother conversation. You need to have a financial professional, a financial advisor, or someone that could advise you how that works. Diversify your account. Don't put all your eggs in one basket. Many ways to counteract that. But when it comes to just moving everything over, make sure you understand that. Don't be fair-mongered. Oh, just because I have this account, the market dropped 1.4 trillion. You keep hearing it, 1.4, 1.8 trillion, the biggest day of loss since, the Great Depression days. I've seen all kind of posts. Don't focus on that. You've had the biggest day's losses, you have the biggest day gains. When in doubt, zoom out, look at the long term. But if you're interested in moving your money into an annuity, understand if it's qualified or not qualified to be taxed. That could save you a lot of headache, folks. Just wanted to drop that for y'all. See you on the next one.